Recording has started.
We're underway. Well, welcome everyone to the Miromiro meeting. We'll open with a karakia meeting.
Ka tuku mātou kia kaha mai ngā māngai mō te Miromiro ki te mahi me te ngā karaoha me te aka mahi ngā pūkinga me te mātauranga I roto ngā wanga me ngā whakakaranga kia ka ture ai te tahi hapori matatikanga e tuku tahi ana kamutu ka ka piki anō I te oranga o tō tātou rohe ka ka tau anō I ngā whake o te rohe nei te tika te kono. We ask that through Te Miromiro's discussions and decisions, the members we have may govern the whānau district imagination, skill and wisdom to achieve a fairer and more united community that enhances the well-being of our district and solves the district's problems efficiently and effectively.
Amen. Just a few opening comments there that the Te Miromiro Committee serves a really important purpose at the Council. It's the eyes and ears of the Council regarding the stewardship of our people's money that they entrust to us by way of their rates payments and payments for other services. So it is key in the Council maintaining the social licence to operate. Our people expect that in exchange for their rates, this Council provides community facilities and the necessities for civilised life in this beautiful part of the country that I'm rapidly getting to know. It means that we're looking for good roads, safe drinking water, good sewerage, as well as good quality community facilities. We must remember at this meeting, while we're providing all these things for the people, it brings with it risk. Risks in delivering, risks in not delivering. Risk can be positive. It's not always about the bad stuff, so just remember that. It's about taking some chances to get some really good outcomes, but doing it in a sensible way. To make progress, we have to take risk. Risk isn't something that we should be scared of. We should embrace risk from the top of the organisation to the bottom. Everyone should buy into it. There's something about risk that most people don't understand. Risk until it becomes an issue, and that's the difference. Issue is something that's actually happened. Risk is a potential. So just thinking back of people's investment strategies back in the global financial crisis, and Earl, I'm sure that you will be nodding your head. People thought that they understood risk and they were prepared to take risk until something went wrong and they found the financial consequence, and their appetite was actually not what they said it was. People did diversifications. I saw one situation of an organisation that diversified. They invested in 5 different finance companies. All of them went west. That's not diversification. That's not managing your risk. It's not sensible. One thing that we do need to think about, and I challenge for the councillors present, is this next LTP process. Our people are fiscally really challenged at this time, even more than normal. And in every decision we make to spend or not to spend, we must be focused on what the spending is delivering for our people, and if we don't spend it, what are the risks we're accepting in the future? And do it with a risk lens on, to giving good outcomes for our people and having honest conversations with them, that there's a trade-off between the rates that they pay and what we can deliver, and what's really the most important things. And when we make these decisions, or the councillors make these decisions, it's going to impact on the future of our people in the region, their children and potentially their grandchildren, because today's decisions do have a long-term impact. And this is what risk is. We're not just thinking immediately, we're thinking about the risks right the way down for potentially for generations. Do we put in that water plant? Do we not? What do we do? It's going to make a difference. So at today's meeting, we're considering a wide range of matters. We've got an economic update shortly from Earl, and we'll hear of what the interest rate forecasts are. One thing I would counsel you to think about is that interest rate changes are not part of the CPI. So we need to think about our increased cost of delivery of what we're doing in terms of CPI and relevant indexes, but we also need to look at the impact of future interest rate changes that are coming at us and the best information that Bangor can get us, because that's going to be quite significant. We've got $105 million worth of debt. So if that moves 2 or 3%, that's $2 or $3 million we've got to find to service it. We've also got a comprehensive health and safety report, and we must keep our people safe. They must return home to their whānau unharmed, and we need to look. Also, today we're going to look carefully at our level of service to ratepayers. So just remember, when we deliberate these matters, we're here on behalf of our people, and that we're here for them. We have stewardship responsibilities. So just bear those thoughts in mind as we go through. And at this point, we will look for apologies. We have an apology from... So we've got an apology from Deputy Mayor Kelly. She's unwell today.
And Panatoy has joined virtually.
And good, thank you, welcome Panatoy. So we've got almost a full attendance, which is excellent.
We'll have a mover and a seconder for the apologies, please, Chair.
So
Yeah,
yes.
I'll second them.
Second move and I'll second.
Okay, you can move, Pepo, and we'll go you a few seconds. All those in favour?
Aye.
Carried. Now, declarations of interest. It is important that these meetings that we are seen to be independent and not have any conflicts, and Sunshine is a very effective. So bringing these items out, and I realise that all members, etc., have made declarations of interest informally with the council and they're on record, but are there any issues today with today's agenda in particular that need to be flagged? I'll take it with silence that there is none. We have no deputations. Now, if everyone at the meeting is happy, I propose to rearrange the agenda slightly and bring forward 6.1 Bangor Treasury update prior to us doing the confirmation of minutes. Is there any objection to that? In which case, Earl, I'll hand over to you for a Bangor update. I've attended a few of those in recent weeks and they've been very illuminating.
Thank you very much, and good morning, everybody. And I apologise for not being there in person, but these drought conditions we're seeing on Waiheke Island in the far north are obviously affecting travel. I think we'd all be looking forward to a drought, wouldn't we, after the last few months? But it is what it is. Now, should I share? Oh, they're there, right? Okay. Okay, so if we go to if we skip through to slide 3. The next slide, yep. So basically back one, sorry. Back to slide 3, sorry. Yeah, that's it. Yeah, if we look at the risks we face, and you know, I thought that the opening comments about risk were extremely valid, and you know, I mean, doing nothing is very risky, and doing everything is very risky. And the good thing is the council has got an appropriate framework where it manages financial market risks. But at the end of the day, managing risk can only postpone the impact of significant changes, and that's what we're trying to do. Okay, so the key developments we're seeing is that we've come towards the end of the current tightening cycle, just about. It's almost like the roulette wheel that's spinning, and you're sitting there waiting to see whether it's going to finish on black or red, and those last little spins of the wheel, and we're not sure what's going to happen yet. So the Reserve Bank here in New Zealand has made it pretty clear that it thinks it's done enough at 5.5% to get inflation back within its target over the medium term. We would agree with that, and we think that if anything, 5.5% is probably a bigger impost than you would see in normal conditions. But what are normal conditions now? You know, we've got huge increases in debt in the private and the public sectors. So, but we think that they've done enough, and we also agree with their view that they're not going to cut interest rates till late next year, early 2025, because they're going to make it really certain that inflation's under control. Now, in the US, the Federal Reserve's at a similar sort of phase. They're saying they might put up rates again, but then they're also signaling that they think rates are restrictive and they haven't seen the full impact of previous rates yet. So, and the main reason why the Federal Reserve is still leaving open the option of further rate increases is that the markets are forward looking. Markets always look what's going to happen next. And in March, April, May, markets were quite confident the Federal Reserve had finished hiking when it was at 5%, and they started to aggressively price in rate cuts in the US. Now, that didn't help the Federal Reserve trying to slow the economy down and get inflation under control. So the Federal Reserve doesn't want the market to aggressively preempt. So it's continuing to stay, we might do another one, we might do another one, pushing out that easing cycle until, again, later next year. In Australia, their rate has peaked at 4.1 so far. The market expects another hike from Australia to 4.35, and that's probably it. And the reason why Australia's had a much lower peak in this cycle is that the impact on mortgages in Australia is almost instant. Most Australians have floating rate mortgages, and so we're seeing a massive, impact on rate hikes. So that's one of the reasons why Australia's, had a lower peak. Again, we're getting near the end of the cycle in Australia. Now, against this background, we've got Europe, which is starting to show low inflation, is starting to slow. Those energy costs after the Ukraine war have come back. The Chinese economy is really battling to sort of get up to those levels of growth we're used to. They've got a 5% growth target now, but they've got serious issues in their housing sector, prices and overhang and unfinished properties. There's a lot of pressure on President Xi to try and put more and more stimulus into the economy, but he's trying to pivot away from debt-filled growth. So it's a challenge, and that's got a direct impact on New Zealand because they're our biggest export market. And then in the background, we've still got Ukraine, and now we've got Hamas. So the geopolitical outlook for the world is mixed. And then to throw into the mix, we've got the US presidential elections. Now, the Americans will start getting into campaign mode late this year, early next year, and they'll just become insular as they talk about the election. And it looks like it's going to be Trump versus Biden. So, that's going to be an interesting thing in itself. So if we go to the next page, page 4, if you look at what our outlook is, as I said, we think that the Reserve Bank's done enough. We're certainly seeing, that impact going through consumer confidence. Consumer confidence is still very negative, and the latest survey was done just last week. Negative 38% of people think it's a good time to buy a major household item. So households are really starting to cut back on spending and really coming back to core spending only. The spending splurge we saw during COVID, where everybody was buying stuff online, they bought their new TVs, bought their new whatever, that's history. And the retail sector is really, they're under pressure. And we've got really high interest rates. The US 10-year bond has traded above 5% in the last month, and that's the highest level since 2007. Now, one of the factors putting that up is just higher for longer. The Federal Reserve talking about no rate cuts till late next year, but also the US government and the US Treasury is issuing huge amounts of bonds. To put this in perspective, pre-COVID to now, there's a more than $1 trillion increase in the amount of debt that the US Treasury is issuing. $1 trillion. So it's gone from about 2.6 trillion to over 4 trillion. So with that amount of debt being issued, you've got to pay a high premium for people to want to invest. And also at the same time, the Chinese and the Japanese aren't investing as much in US dollar assets as they do normally. For 2 reasons. One, they've got problems at home, but 2, the US dollar is very strong, and China and Japan are trying to stop their currencies weakening too much further, and that means they've got to sell US dollars, so they've got to sell US assets. So they're not big buyers of US bonds at the moment, and one of the biggest buyers of US bonds over the last 3 years has been the US Fed itself. As central banks were stimulating the economy, our central bank did it as well. They bought bonds to put money into the system. That's stopped now, so that's actually a pressure. So all those factors mean that, while we think we're basically at the end of current tightening cycles, it's really going to be hard for interest rates to fall dramatically because of these funding pressures we're seeing. The New Zealand government's funding pressures are the highest they've been for a long period of time. We're issuing lots of bonds, so there's lots of headwinds for lower interest rates, and we don't really see domestic interest rates starting to fall. And for as far as the council's concerned, you know, those long-term rates through the LGFA, probably until the second half of next year. So we've got to be patient. We don't want to be locking in lots of borrowings at the top of the cycle. You know, locking in funding at 6% for 10 years doesn't seem to make sense. We're in the top of the cycle, but we've got to be cognizant of, you know, what kind of interest rates we're targeting to actually, you know, start to extend again. And we've got to get out of our mind, you know, those 2 years of low interest rates and markets talking about zero interest rates, that's a once in a lifetime event. That's gone. That's not going to happen again. That was a situation that we all lived through, and our grandkids and our great grandkids will go, really? Has that happened? You know, that was a one-off event. So we've got to get that out of our mind and adjust to normality, which is higher interest rates. But they're still lower than historical levels over the last 20 years. So that's something we've got to get our mind around as well when you look to manage risk. Don't think about, oh, they were zero once. Well, you know, they were 20% once as well. So we've got to just look forward. Okay, if we look at the next slide, I'll quickly go through some of the things we're seeing out there through data and slides. So we have an interest rate dashboard, and we look at the various factors that are affecting interest rates over the next 6 to 12 months. Now, if you look at all those factors, they're either neutral, implying no change, or they're negative, implying interest rates should be going lower. So if we didn't have a inflation problem because of all that stimulus during COVID, the Reserve Bank would be looking to cut interest rates. But we understand that while that is the normal framework we're seeing, they're going to keep rates higher for longer because they're terrified about getting inflation out of control, and they're terrified about making the same mistake they made in the easing cycle. They made monetary policy far too easy at the same time as the government and the government was stimulating the economy aggressively. They pushed a whole lot of money into the system by buying bonds and printing money effectively. So they're not going to make the same mistake of undercooking their tightening cycle. So they're going to err on the side of caution. And that's not good for households. That's not good for the short-term impacts for the economy, right? But we know that's going to happen because it is what it is. Okay, if we go to the next one, next slide. And this shows some of the structural problems we have in the New Zealand economy. So this is bank lending since the global financial crisis, which is, you know, God, it was 16, 17 years ago now. It seems like yesterday sometimes. Now, the global financial crisis was a big event, but it's sort of gone into the mists of time. But if you look at that, so bank debt, that's bank lending in New Zealand, has increased by 307 billion since 2007. But 150 billion, over half of that has been to households. And since 2020, households have increased their debt by 70 billion, and that's nearly 90% of total lending. A scary stat is that since 2020, lending to the agricultural sector has actually declined by 0.1%. And lending to the business sector has only been about just over 10%. So money has poured into the housing sector, and this is different to many other countries, right? So, and COVID has just exacerbated those flows. So households are indebted. While we're all sitting, if you own a home, you're going, oh, great, my house has gone up in value. The reality is those increases in values have effectively been debt fueled, and the interest rates on that debt is increasing. That's why households are under pressure. And the scary thing for the New Zealand economy over the next few years is there hasn't been, you know, we haven't used this massive money printing and debt stimulus from the government to actually put money into businesses that actually do things and sell exports. Agriculture's been under pressure, you know, businesses under pressure. And those are the things that pay the bills for New Zealanders to actually live how we want to live. So there's going to be a tough few years, I think, because households have got most of the debt. And at the end of the day, you don't become a wealthy country by selling houses to each other, no matter what any real estate agent says to you. Okay, Now, if we look at the next slide, this is starting to. So this shows, these higher mortgage rates are starting to impact on consumers' wallets. And as you can see on the slide on the right, New Zealand is the orange one. We've had a nearly 4% increase in mortgage rates over the last few years, so while our policy rate, our increase in our cash rate is in line with the rest of the world, the impact on New Zealand's wallets through higher mortgage rates has been the most dramatic. That's why the New Zealand economy is slowing quicker than others, I think, and that's because New Zealand's indebtedness in the household sector against mortgage debt is very, very high. So consumers' wallets are being hit by higher mortgage rates, and there's more to come yet, because there's still probably 30 or 40% of mortgages are still coming off fixed rates over the next 6 months. So consumers' wallets are being hit, and they're going to be hit for a while yet. We look at the next slide. This is showing exactly in what's happening to households' spending, right? And as the previous point about putting up rates and stuff for your constituents to do things, that's a sound thing to do, because we need to spend money to increase our infrastructure and make better quality of life. But when you look at this, households are under pressure. So households are basically saying we're spending a heck of a lot more on groceries. Interesting, domestic travel's holding up. A bit of gardening, you stay at home and you put in vegetables. But all that discretionary spending, PCs, sporting equipment, motor vehicles, clothing, all that kind of stuff, people are going to be spending quite a bit less because they haven't got the money to afford it. So people are focusing on the core things, putting food on the table. And the excess savings we had from COVID have just about been extended. So this is why we're seeing pressure in retail and hospitality, all those things, because consumers are finding it tough. And that's right across the country. Okay, if you look at the next slide, this shows card spending. So the volume of card spending, so people are spending less on their cards, but the value is still going up. So you actually, this just shows you're paying more for less. But we've had inflation of 8-9%, and the value of credit card spending is going down. Again, a very strong signal that households are cutting back on discretionary spending. Okay, we'll look at the next one. I'll try and find something cheerful soon, I promise. Look at the next one. Consumer confidence up a little bit. There was possibly a little bit of a bounce from the election result. Maybe not the result, just politics being central politics being out of the news for 3 weeks. Everybody thank goodness for that. But still, we're at very high levels, and consumer confidence is at levels, the same levels we saw in the GFC. So consumer confidence is very, very weak. Okay, we look at the next one. The farming sector under pressure, and in the rural areas, and far north, and out of the cities, this has had a big impact on what's going on in your towns and your service towns, because farmers are spending less. So there's the so commodity prices have fallen a long way. They're starting to find a bottom, hopefully. But the interesting thing is the food price index has gone through the roof. So farmers are actually getting less for their exports, but because of climatic conditions and things like that, everybody here is paying more. So we aren't even getting the benefit of low commodity prices for farmers. At least the consumers paying less. This is horrible. Farmers are earning less and consumers are paying more. So nobody's a winner in that situation. And then if you look at the farming sector, the next slide, massive increase in costs. Now that fertilizer cost has come back quite a long way. So that's improved quite a bit. But if you look at that, you can see why the farming sector is, again, pulling its, tightening its belt. Costs are up, income's down. It's not a formula for farmers spending a lot of money in the cafes in the rural towns. I was in Te Awamutu a couple of weeks ago, and I was in a cafe before my meeting and talking to the cafe owner, and she said that Thursday, Friday morning, they'd get the farmers would come in, meet their mates, have a coffee, have a breakfast, and talk about things, right? She said about 2 months ago, it just stopped. They're seeing no farmers coming into town on Thursdays or Friday mornings because they're tightening their belts. And that has an impact right through the town, right? You know, the cafes aren't doing so well, so they're not doing spending. So these things are, you know, rural New Zealand is, you know, there's definitely, you know, even more belt tightening going on. Okay, look at the next one. A bit of good news here. So far, we haven't had a massive increase in oil prices due to the Gaza Hamas thing. Now, oil prices went up in the middle of the year, and that was mainly due to the Russians and OPEC continuing these deals where they're cutting supply, right? But at this stage, oil prices haven't surged to the levels we saw sort of in 2022, and that would be really bad. But at this stage, fingers crossed, that situation in the Middle East isn't expanding to other parts of the Middle East, and oil is actually holding, which we don't want oil prices to go up through the roof, because that's going to be really bad for inflation, and central banks have to put up rates again, which is not good for anybody. At this stage, we're watching oil very closely. Okay, and the next one, the reason why we're, you know, while oil prices haven't gone through the roof, the reason why we're seeing higher pump prices is the New Zealand dollar's fallen. It's been falling for quite a while now, but it's back down at sort of 58 cents, which is, you know, these are multi-decade lows. We saw it fall to 55 cents during, there was a sell-off last year, and then we got down to there during COVID. But these are, the New Zealand dollar is weak, which is a real benefit for our farming sector and our export sector to offset the lower commodity prices, but it's not good for imported inflation, right? So that's why pump prices are sticky, even though oil is starting to ease back from its highs again. Okay, and we look at the next one. This is just the IMF's expecting subdued growth globally. So New Zealand having weak growth, we're not by ourselves, you know. So they're talking growth of 1.1 this year and 1% next year, which is better than, you know, we were looking at recession and negative growth for a while. But the global outlook for growth is weak, right? So that's not positive for a commodity exporter. So, you know, and historically this would lead to lower interest rates. But because we've got this inflation surge because of all the stimulus during COVID, central banks can't cut interest rates in response to lower growth. They have to stick to the course to get inflation under control, because long-term high levels of inflation are really damaging. Okay, we go to the next slide. Core inflation is coming back. That's the good news. And as you can see in China, they're actually going towards deflation again. But while inflation has come back a long way from its peaks, it's still a long way from those targets. Most central banks target between 1% and 3%. That's the dotted lines. And as you can see, there's a ways to go yet. New Zealand, we're sort of, we're still up. Ours is delayed because we have the quarterly. Now, I think we've done our latest one and we're still around 5-ish. So everybody's got a way to go. So as you can see, central banks are going to take a while to talk about cutting, because those inflation numbers have to be in those dotted lines. And the first 2 or 3% is kind of easy, but the next 2 or 3%, the next couple of percent is going to be much more difficult. So that's why this higher for longer mantra you're hearing all around the place. Okay, next one. And this is what I was talking about before. So US interest rates are high because they're just increasing massive, there's just massive increases in US bond issuance to fund their deficits. Now, the good news for this is that at some stage, markets will dislocate. They'll say, well, the reason why US rates are staying high is because they've got this problem where they're issuing a lot of debt. So we could possibly see New Zealand interest rates start to fall late next year or in the second half of next year, even if US interest rates are sticky, because some of this is a US specific situation, right? So that's a glimmer of hope for domestic interest rates going a bit lower. Okay, the next slide. This shows what's happened to the US 10-year bond yield. Big spikes higher, starting to 5% starts to look a bit toppy, but it's certainly broken through the previous highs around sort of 430, and we really need to see that US rate come back before we start to see our rates decline. The worry is that these high interest rates in the US will create a hard landing, i.e. a recession in the US, and that'll have implications globally. But at this stage, we think that they're going to stay high for a little bit while yet. And the next slide, that has an impact on our rates. So our 2-year rate is around about 550 at the moment, and that's in line with the where the OCR is. Now, it hasn't gone higher despite the US higher because, you know, it looks too dear at much above 5.5%, especially if we believe that the OCR is finished at 5.5. So we're going to see our interest rates, they'll come up a long way, and then they'll go sideways for a while until we start to see evidence that the Reserve Bank can start to cut, which is a next year story. Okay, and we look at the 5-year swap rate, which is where we tend to borrow from the LGFA. That's kind of, you know, the sweet spot. As you can see, that's moved up a fair bit, and that's been sort of capped around 5% for about a year now, and then it's peaked up over the last little while. It's just starting to come back again as we see, you know, but we're not going to see meaningful declines until the Federal Reserve is done. But all these rates are at sort of at historical highs, so we're not really wanting to do more than we have to long term to, you know, at these high rates. We'd rather sort of look for opportunities next year. Okay, if you go into the next slide. So this is quickly a borrowing update. So if we go to the first slide, it shows where our interest rate hedging is currently. So go to slide 22. So at the moment, we've got a minor policy compliance requirement from sort of October 25 into 27. Now, most of that is because debt's been increasing, and there's been a lot of uncertainty around, you know, what's going to happen to the debt. You know, you're doing a new LTP, we're doing a new, you know, Three Waters. What's going to happen there? I've got a few thoughts about Three Waters. You know, we're expecting to lose debt from the council and lose the assets as well, but that was going to have ramifications for the profile. So this is not too bad, quite frankly. But we have to do some. We're going to have to term out some debt over the next 6 months, heading into 30 June to, you know, to get back in line with where we think debt's going to be. And those updated LTP debt numbers will be useful in getting a picture. So if you look at the next slide, that shows where our so we've got $100 million borrowing limit, you know, just having a maturing in any 1 year. So we've got heaps of capacity to borrow into lots of time buckets. So we can actually access all the different LGFA issuance levels, issuance dates, and there's no constrictions on that. So we've got lots of flexibility. We're just going to have to bite the bullet and do some longer term funding over the next you know, few months, because debt has increased, you know, and that means we need to keep inside, you know, we need to keep inside policy. But, you know, our overall strategy is keep inside policy, but keep a high, you know, not do too much. It's second half a year story when we start to term out. We're looking for rates with a 4 on the front, and we think we'll see those. We saw them in May, June, but there was a lot of uncertainty around Three Waters and your debt profile, and we thought that happened a bit quick. Rates are higher for longer at the moment, but the curve will change, interest rates will fall, and that's when we'll start to be more aggressive in fixing. But we're pretty confident that, you know, the Far North District Council's all up cost of funds is going to stay, it's going to have a 4 on the front of it for, you know, through the foreseeable term. We, you know, despite current interest rates over 5%, we still see your all up cost of funds, including your margins, because of previous hedging in place, and what we're doing is going to be, it's going to go higher, but it's going to stay with a 4 on the front, hopefully, despite what we've seen in the last month. Okay, now I think in the next slide, I've just got a quick few thoughts around Three Waters, because, you know, it's going to be repealed. You know, National Act agree with repealing. New Zealand First haven't got a contractual review. Now, Nationals, the model looks to be based on the Castelia model. Now, Far North District Council is one of those Communities for Democracy Council. So, you know, the council will be aware of the kind of structure going forward that's probably going to happen. Now, who knows? You know, politicians at central government level, you know, the bureaucrats get involved. Who knows what could happen? But from what we know now, it does look as though we're going to move to that sort of situation. So, you know, there'll be get rid of the big water entities. ComCom will be looking at minimum standards. Councils are going to have to, within 12 months, come up with a financially sustainable options around Three Waters. And then this financing, financing options will be developed. Now, in our view, that's got to be central government involvement. Whether they facilitate lending for councils or fund councils indirectly, or whether they get whatever they do, there's going to have to be central government's going to have some money in this game somehow. Now, it's not going to be we'll take your assets, we'll take the debt, and then you just go forward, in your balance sheet just changes on both sides and away you go. There's going to be some sort of complications, but broadly, there's going to have to be a partnership between council and central government. And so, from a debt point of view, we're not really certain the short term how that's going to impact and what it'll mean for your projections. So there is still a high level of uncertainty around, what's going to happen for your debt. And that's me, I think. So any questions or any sort of insights or any?
So, Pinatoe, did you have a question? I couldn't quite see whether your hand was up or not, but it was on a small screen.
No, I don't have any questions. Thank you, Earl. Very informative. I did send a message to everyone. Can we please, is it possible for you to circulate your presentation? That might be really helpful for the councillors that aren't here at the moment. And other than that, no, cheers, mate. I found that really helpful.
Yeah, Janice has got a copy, so she can circulate it, I'm sure.
Cheers.
Any other comments, Steve?
Yeah, thanks, Earl. Just on the slide there where you talked about our, I'll refer to as household debt versus the productive sector debt, primary industry and business, that's really concerning. If we have another fall like 2007, the GFC, that'll hurt. But the other part that I'm involved in, I farm a few cattle. And one of the things that's hit us is the US dollar, the drop, or our fall in our dollar, the weakness. The inputs are up, so farm, fertiliser, grain's up. There's a lot of grain used in our dairy industry, for instance, and that reflects in Ukraine and Russia. They're a major producer of those food staples, grain and spuds and things. But with the increase in grain fertiliser, we're going to see a reduction in productive performance across the industry. So I think we're going to see a fall in our GDP returns of our agricultural sector because of those high pricing of fertiliser and the reduction. While the commodity looks all right now, watch this space, I think. Do you factor that in?
I think you're absolutely right. Our view is that farmers have to tighten their belts, right? Because as they input costs are going up dramatically, you've got higher wages, you've got lower returns compared to, historically. So the weak dollar's helping on the income side a little bit, but it's really hurting on the cost side. And so we're seeing, when we talk to our clients in the dairies and the meat industry and other kiwi fruit, logs and things like that, the farmers, fertiliser is an expense you can cut quite quickly, right? And you can probably do it for a year, can't you? But so you're going to have to. So farmers are saying we're not going to run hard to try and put production up to basically cover the increases. We've got to batten down for this year and hope things stabilise. So I think you're right. I think the impact on GDP of agriculture and the farming sector in general this year is going to be a bit ropey because farmers are getting squeezed both ends. And you've got to turn the taps off for the cash you can straight away, right? And unfortunately, the banks won't let you turn off the mortgage payments, and you can't. You still have to milk the cows. You still have to, do the sheep, all those kind of stuff. So certainly, and we advise the two big fertiliser guys. I don't have nothing to do with it, but and certainly their outlook for fertiliser sales is looking a bit dodgy at the moment. That's for sure.
And then that also highlights a risk or puts a potential risk in our processing plants, reduction in stainless, requirement for stainless steel capacity in our freezing works, dairy factories and so forth. And if we lose those, it actually increases costs of that or reduces return at farm gate because suddenly the costs increase. If we've got none of our sheep are killed in the north anymore, they're all down to Rangiora or right down to Manawatu. And then and our dairy production is dropping dramatically across the north. A lot of farms are being converted. And if we lose another dairy factory up here, you know, just the opportunity to maintain some returns at the gate, and that impacts our little economy hugely in the far north.
Yeah, and unfortunately, I said I'd hope to say something that's good news, but like we've got real concerns about the farming sector over the next 12 or so months, and it's going to be tough. Now, tourism is going to help, but at the end of the day, it's still nowhere near COVID. And as we're getting we're starting to get a lot of Chinese tour groups coming onto Waiheke, which we've never had previously, right? They come on a bus, they walk around, they leave, they don't spend any money. We need tourists that stay for a week and spend, right? And you know, tourism's great, but you want them to be spending money, not just sort of looking at the grass then leaving. And you know, tourism's going to help, but it's not the golden, it's not the silver bullet, that's for sure.
Hi Earl, it's Anne here. I've just got a
Hi, Anne.
question, and I'm wondering if I misunderstood slide 23, where you were talking about our funding profile, and you talk in your bullet point at the bottom, significant headroom across all funding buckets. Our debt at 2021 was 159 million, and it was forecast to be 331 at 2031. And the message we've been getting is that we don't have much headroom in our debt ceiling, but that slide is telling me something different. So I'm just wondering if I'm misinterpreting it.
Oh no, this is a Treasury policy parameter slide. So in your Treasury policy, you have a restriction that you cannot have more than 100 million of your debt maturing in any 12-month period, and that policy's in there to stop, you know, stop having all your debt maturing, say next year, and we have a global financial crisis. Credit margins go through the roof, interest rates go through the roof, and you reprice the whole lot in a 12-month period. It's just spreading your. It's a way to spread your risk, so you don't put all your eggs into the one maturity basket. It's got nothing to do with your headroom constraints around your covenants and all that kind of stuff. So sorry. It doesn't. This chart doesn't mean that you can go and fill all those bars up to 100 million and have $1 billion worth of debt. All it means is that when we're looking to borrow the debt that you can borrow within those other constraints, we can cherry pick the LGFA maturities. Where, in other words, we're not constricted that because we've got so much debt maturing in 4 years' time, we've got to borrow longer or shorter to meet this policy. This is a Treasury policy constraint, not a this doesn't reflect what your constraints are on the total amount of debt the council can have.
Thank you.
If I could perhaps ask one question of you, excuse me. What's the impact of possible change in focus at the Reserve Bank with the likely, well, we know we've got a change of government coming, and they've indicated changes in the Reserve Bank focus. Is that going to have much of an impact on us?
So they're going to take away the employment clause, and they're probably going to get rid of the Monetary Policy Committee because they want accountability. So changing the at this stage, unemployment in New Zealand is going to come out this week, and they reckon it's going to go from 3.6 to 3.9, which is still historically very, very low. So we're a long way from unemployment levels before the Reserve Bank would be saying, oh, we've got to cut rates because unemployment's getting out of control. And the Reserve Bank's actually said they want to see unemployment increase, which is horrible, but that's the way monetary policy works. So at the margins, it might mean they could keep interest rates a little bit higher for a little bit longer, but I don't think much. And going back to Adrian Orr being the sole decider of monetary policy, he's a bit of a dove in general terms. He tends to like to have rates, to wait and see about hiking. But I think if they change the conditions and he's the final decision maker, and his responsibility is totally about getting inflation under control, he's probably going to have to be a bit more aggressive. So I don't think it'll have much of a difference at all, quite frankly.
Thank you. Any other questions before I sort of sum up with a few thoughts? Okay, well, if rates are going to stay up and for a bit longer, although you've mentioned that that they will in the longer term drop, I suggest that maybe you're going to need a reasonably good pair of binoculars. before you see anything happening too much. We need to think here about the risk that this creates on the council and the impacts on our ratepayers' ability to fund, but also the ongoing costs of servicing that debt and the inherent inflationary risks and pressures on us providing the services to our ratepayers, and think about this in terms of what our assumptions are in the LTP that are coming through. That debt of all the household income that's out there and has to be serviced. So as the remaining 30% or so, or 40% fall off lower rate fixed coming forward, we're going to see an increased squeeze. That's going to reduce the amount of discretionary income households have. It's going to impact on the ratepayers and the businesses of our ratepayers, and generally tighten things down. So as I see it, there's probably in 2024 more pain to come through, and we're only just starting to see the start of it. And I certainly in my own business doing forensic and litigation support, I'm thinking 2024 might be a bigger year as people start examining and going into defaults and disputes and that sort of thing start happening. So just ask the councillors to really think about this update and what it means as they deliberate on their LTP and where we're going and what we're doing for our ratepayers under our social licence that they have given us by the election and our responsibilities of stewardship. So if there's any other closing comments, or if there's not, we can let Earl get on, but you've got one, John?
Yeah, I agree with you, Graham. I think that's definitely a risk to us. If you look at the costs that are out there, our contractors themselves, we want to push the prices up, and affordability to ratepayers, that high household debt is going to be quite a challenge for them to meet their debt requirements. So, yep, definitely I agree with you that there's considerations that we have to take into account.
Any other last comments?
Just need to move a second and a vote on that when you're ready. Sure.
Right, we will move on. There's a recommendation that the Miromiro Assurance Risk and Finance Committee receive the Bancorp Treasury update. Anne, are you happy to move in that direction? Steve, you're happy to second? Yes. I'll put the motion. All those in favour? No. Against, if any? Carried. Thank you, Andy, for your involvement in a very informative update, as always.
A pleasure, and I apologise for not being there, but even I can't make the weather gods do the right thing. So hopefully I'll see you all live in the not too distant future.
Thank you, Earl.
Kira.
Right, we'll resume to the normal, back to the agenda now, and the first item, 4.1, confirmation of the previous minutes. We'll perhaps just go through those previous meetings, do a page turn. If there's any points of fact, there, page 1, 2, 3, 4, 5, and finally 6. There are no comments. The recommendation is that Te Miromiro Assurance Risk and Finance Committee confirm the minutes of the meeting held 9 August 2023 are true and correct. John, are you happy to move in that direction? And are you happy to second? Any discussion? I'll put the motion. All those in favour? No. Against, if any? Carried. Are there any items within this that are not covered off and matters arising in the agenda that anyone wishes to raise? Thank you. We'll move forward now to item 5.1. And Janice, will you speak to this, or have we got Joshna's?
We're both here.
So Joshna, you may wish to come up and join us at the table.
Yeah. So this this report is to introduce. Okay, I'm Joshna. Joshna. I think first time I'm appearing in this side of the table, not on that side. So at council with this with risk in place, we started we're doing a risk reset, and to do that we've revamped our risk policy, and we've introduced the risk framework, which is the tool at which we are using to address risk at council. So, self-explanatory on reading the policy and introduction of the framework with the risk. If there's any questions around the policy and the framework.
So my thoughts on this, that this is all done in terms of ISO 3100, which is regarded as the best practice standards. Reading it, one may think that there's more boilerplate here than a shipbuilder's yard. However, it is the accepted framework that we move within, and it's been around since 2009, I think, if my memory serves me right. And this is really regarded internationally as a best practice framework, and it's for us now to utilise this framework and policy to start moving our risk management processes forward. But is there any particular questions people have got? There is, just to highlight, there is one typographical error that was in the framework, I think it is, on page 25 of the papers. And that is the range in the traffic light situation for the high. It's got 16.999, that should be 16. It's the maximum risks, if you multiply together, of the likelihood and the consequences 4 times 4. So that was an inadvertent issue. I think an updated paper has been circulated around or is about to be. Is there any questions, or I can run through if you like and give a wee bit of a background, or Joshna, or we've got Janice here also.
The question I have, so we're just introducing this as a new policy, is that correct? Or
That's,
has it been in place?
yeah, bringing an ISO-based framework into play to give us a long-term framework to work within. And that ties in with our risk management software, which is in the throes of being implemented.
Can you give us a run through, please?
Yeah, so I guess the key thing for me is realising that we've got 3 lines of defence. We've got the risk owners within the organisation, excuse me, being a bit croaky. We've got the risk owners who is effectively the chief executive officer, the group managers and the managers reporting to them. And they will be monitoring risk on a day-to-day basis. We then have a second level, which is our risk and assurance, effectively, where we're undertaking tasks for monitoring and providing reassurance and assurance. And then our third line, we have internal audits happening in specific perceived risk areas. And coming through the process, if we nip, that's page 21, and in thinking about it, moving to 26, which is the revised paper that's being circulated, we look at each risk that we identified in a raw state, and we then look at how likely is it to happen. Is it rare? We give a value of 1. Is it possible 2, probable 3, or if it's likely, it's a 4. We then think about the consequences if that risk materialises into an issue, and say, If the consequence of it happening is very minor, we again describe a 1, moderate 2, major 3 or extreme 4. So we modify that together to give an overall weighting, and that ties into the table that's been amended. So if we have a rare event and if it happens very little consequence, we have 1 times 1, which equals 1. So it's going to be classified as a minor item. On the other hand, if we have an event that is highly likely to happen and the consequences are extreme, we multiply 4 by 4 and we're at 16, and that gives the red traffic light. The higher the risk and consequence factor, the more focus we need to give because of the consequences. And if it's a consequence for us, it's a consequence for our ratepayers and our people within the district. So that's at a raw state. We then put in controls and we monitor and mitigate, and things like insurances, close monitoring, preventative maintenance, all these things happen, reduce the risk. And what we need to do from time to time is evaluate how effective those mitigations are, and are they there? And that leaves us with a residual risk, which we then compare against a risk appetite. And do we need to do more, which usually means incur more costs on behalf of our ratepayers to manage it, or have we got the risk down to a level that we can live with and is good business practice and prudent? So we develop a heat map, and I think, Josh, you've got a heat map in here somewhere, haven't you? Do you have a page number for me?
I've got it on page 31.
Page 31.
Okay.
So at this committee, I'd expect the items that are in red to be getting regular updates to us as to what we're doing, either to manage, mitigate, lower the risks. Whereas I would not expect this committee at a governance level to be worrying too much about the stuff at the low end in the green, and we'll leave that with management. But if anything changes, we start looking at a governance level for guidance and what are we doing. So this is all very traditional, as I said, boilerplate way regarded as best practice internationally, and has been for well over a decade. So what we should be seeing is if there's a rise in a risk or something's happening, we're seeing reporting coming through to governance in those areas. Stuff that's high risk, we should be getting regular updates. And what we all need to do, management and governance and councillors, is scanning the horizon with your binoculars, trying to anticipate what's coming at us, what I call a horizon scan. So how have I gone in summarising that, Janice? And
very well, thank you.
Thank you.
so if that, I'll perhaps open the floor now to any questions or comments coming from councillors and committee members.
You talk about regular workshops. What sort of regular, what do you call regular if we're discussing a framework and going forward?
I'm still putting a work plan together for that. One of the first items on my agenda is to workshop the entire risk module that we've adopted now, together this policy and the framework with the elected members, to give you all risk training. So everything that Graham has just said, in a nutshell, needs to be actually spelled out to the elected members, so we all have the same understanding of how the framework applies and the tool is going to be used. Then that workshop thing, risk, I'm trying to create a risk culture within our organizations. So workshops will be quite regular with different divisions and departments along the way, in order for risk to be a very live conversation in assessing all the risks that council has.
As I said in my opening comments, we've got to get right through the organisation that people are prepared to put their hand up and saying that I recognise that there's a risk here, or I see something coming at us, and are you, the workers on the ground are often the best informed as to what's happening. I can see a risk of, if we don't do something with this drain in the next large rain event, that we're going to end up with an issue. And people with their eyes and ears open, and people working and thinking together. And it really is, risk is for everyone, right from the hourly rate worker that's out there really doing all the stuff and seeing stuff. It's no use to us if they talk about it over a beer and never pass it on. We're not actually doing the right thing for our ratepayers. So, it's got to be from the top down. It's got to be the councils as you're out around your various wards, keeping an eye out, listening to the ratepayers. What are they seeing? Where do they see issues coming at us, and we understand, and we put all this into a big melting pot and distill it through. Now, the work that Josh is doing is actually taking a previous risk framework predating when I've been involved, and we have 10 risks in a subsequent paper that were previously identified, but continuously keeping this under review and saying, is this current? We're in a very dynamic world at the moment. Things are changing faster than I've noticed in 40 years working in the sector, and I'm sure those that have been in councils for many years will be noticing the same things. It's very dynamic out there at the moment with government change, with climate change and climate impacts, more severe weather events, skill shortages like we haven't seen before. All sorts of things are coming at us. So this is very important. Steve, followed by Jim.
Yeah, the next one, you talk about the tool as the CAMS risk model. Council adopted it. I'm a bit frightened of these acronyms. We've got the AMP and the RAM, which has always been hard to follow or get info from. But on page 18 in the compliance procedure, I see there under financial implications, there are no financial implications nor budgetary provisions required in support of this decision, and the CFO has not reviewed this report. What's that risk, the CAMS model cost? I'm just mindful of, we don't want to be wasting money on anything as per Project Darwin, which went nowhere.
Yeah. So the CAMS model is something that was adopted with projects and to handle projects and strategy. And
what's the CAMS stand for?
That's the name of the products that the business.
Software businesses. Yeah, so it's used as a tool. One of the.
Does it have an annual cost, a subscription?
Yes, it does.
Must be big.
It does.
So back to page 18, there is actually a financial implication and a budgetary provision required on an ongoing basis. Is that correct?
Chair, this report is about the policy and the framework, not the system. So as far as the policy and framework is concerned, the statement that's been made is correct.
Can I perhaps ask a question of clarification? Us implementing this into the risk management, am I correct in thinking that we already have the software and utilising it elsewhere in the organisation, so therefore we're getting extra benefit from an existing spend?
Correct.
So there's no additional cost, we're actually tapping into the full value of the software that we're using in other areas.
Yes, it's part of the project management framework software, so around controlling and reporting back on projects, which is something councils have asked for quite some time. So this is standing up the framework, but the risk comes as the module that's attached to that. So we're making full use of the whole suite.
Thank you, Mr. Chair. Just based off the commentary around workshopping, a few people have said to me the latest news article is that the Ombudsman who's come out smacking the hand of councils for using workshops as a means to disseminate information to members. I wondered if we could have a staff background around, just because it's a topical issue right now, around how we use workshops, the appropriateness of them, and one of the things that I've always pushed for and when we're workshopping is that we will often, as elected members, receive a briefing note. We make our briefing notes available on our website for the public, whether or not they are able to come to a workshop,
if it's open to public or not. Can we just have some staff commentary in that space, because that is a risk, and the ombudsman's come out to comment.
Very, very good point you raised. And I was proposing, as we go through to the PX, as part of the discussion about going in, is actually examining what are we talking about and why is it in PX, and if so, when will it be released and why it's being held. And I think it's important that the public need to understand that. I was on a call 10 days ago or so with the Ombudsman on this report, and his concerns are that the ratepayers, that we're stewards of their money, are not actually getting full visibility, and we need to use PX appropriately, and we will talk to that when we come up to that resolution as to the reasons why. And some of them are good reasons, because there's legal privilege involved in stuff, and or there's matters that really involves the naming of individuals, and we have to consider privacy or commercial sensitivity. But I think we need to be very open as to why we're using it, and be, if necessary, at the end, as I did last meeting, give a quick précis at the end as we came out of public exclusion about what actually came through and what the decisions were coming out of that.
I wonder if we could get a colour, if you could indulge us, just because I know this is live streamed and it's something that has come up in the media recently, and within this report we're discussing workshopping the risks of this council. That risk sits on our ratepayers. So I'd really like to have a bit of a breakdown about the framework we work within to be able to use those as an organisation.
My team's reviewing that report at the moment to be able to give recommendations to democracy services around how we currently run our workshops and how we should be, and then delineate between what's in public and what's in PX, and make that appropriate for ratepayer interests as well as marrying up the risk model. So we're still doing in the moment that piece of work, and provide that through the right channels to members of the
Thank you for that, Carla. I mean, it also has to be practical, right? I don't like, we run our formal meeting through standing orders. It's very formal workshops, allow us the opportunity to just sit down and sometimes chew the fat to get better information so that we can make an informed decision in a formal meeting itself. But just it'd be great.
For those that are being live streamed in the room that are not involved with the council, this report was only released at 3 PM last Thursday by the Ombudsman, so it's very hot off the press, and I think it's good that we have our democracy services teams looking at this and really considering. This was not one of the 8 councils that was named in the report as not following best practice, I'd also note. So, but it is an issue, how do we balance some of these matters between visibility, because we are here through the ratepayers. We're acting as their stewards.
Thank you. Thank you.
So, John.
Yeah, thank you, Mr. Chair. Just really a question of Josh. I think all this is good. My concern was not to spend too much time on unnecessarily on rehashing things, and rather get to the more nitty-gritty stuff. So I take it that all of the risk work and workshops and everything we did in the past, you're building on that. So you're picking up that, and then you're going to, and I know it's changed, it's a state of flux, it changes and it needs to be looked at. They're quoting myself, must be going around. So what goes into the Keens risk tool, the software, putting all that in there based on what's there and that, so just comment on the process.
Just through the chair, the starting point for us was the risks that came through the previous work, and then we have reviewed those, and that's the subject of the next paper that we'll talk about in terms of how we've looked at those. What we did find was there was a significant amount of items in there that were statements. They weren't actually risk issues, or they were the same risk over multiple areas. So what Josh has done is to amalgamate those so that we've got a clearer picture of what risk looks like.
Thank you.
Hello, Joshua. Welcome to the dark side. Lovely to see your beautiful face. Joshua, if I read this correctly, the workshops are not just for elected members, they'll actually be right throughout the organisation at every level, yeah?
Yes.
Okay. So at 5.6 risk escalation, all identified and reported risks are to be escalated to risk and insurance. Does that mean this committee? I'm just not sure I understand that section.
Really, 5.6.
Page 27, 5.6. All identified and reported risks are to be escalated to risk and insurance. Does that mean the committee?
No, it does
I don't
not
want to
mean-
receive it.
No, it means my team.
Your team,
My
okay.
team, risk and insurance. It has to be escalated to us. So if it's one methodology I'm using, that if that we are talking, if somebody's, it needs to be not just a discussion, it has to be escalated to us as a department or division to then escalate it into exactly where it needs to be. If it's a risk that's we're going to be you assessing, then it will go through the framework. We'll have to, it's been identified, and then we'll use the framework as the tool to assess the risk. There's also a second part of escalation, which I'm still looking at putting up a escalation process for when things become, on the heat map, if it's really extreme and it's major, and it has the risk itself has escalated to that level, then there should be a reporting of that as well. There's those identified risks need to be then brought to the attention. That will be an internal thing for my team, for me to put together with the staff.
If I may comment from the chair, if we go to page 31, and we've got that traffic light system in the matrix. If it's red, it needs to be here. If it's green, probably this is just handled with management. It's the yellow portion where there is a matter of judgment. And these are risks, but if a risk changes to an issue, i.e. the risk is materialised, and we have a risk that we're going to have high rainfall in the last couple of days, that's moved from a risk to an issue because we've had it, and we're now reacting and managing it to describe the difference. Then we've got to sort of sit down and, with the guidance of the team and the chief executive, look at what items should governance be doing. The councillors also may say that they wish to actually bring something forward and actually get reporting on it, and that's their prerogative. But what we've got to watch is that we're not getting governance doing management stuff, and we're not getting management substituting in for governance. So this yellow band, if you like, through that table is the area for debate.
Yes, so I think that summarises what I'm not clear on is at what point is something that's changing, so it's changing from green to yellow? At what point does that become something that's brought forward to elected members in terms of all of those wonderful objectives that we see on the definitions table on page 28? So particularly political risk, consequences, financial implication. I'm just not sure I'm seeing that, but maybe I'm just looking in the wrong place.
We will be reporting on trends. So if something is trending from yellow to red, I will bring it to the table. We'll manage the risk. Management will be, that's the escalation that you spoke about, the escalation process. As soon as something is trending upwards, then the escalation process kicks in. I'd have to bring it to the attention of my next, after my team, which would be the CEO's attention, and then the CEO would then give the green light to go ahead to come and report it onto this table.
Can I give you an example?
Yeah.
Waka Kotahi have recently announced that they will not be adopting the National Land Transport Plan until September next year. That falls after the adoption of the long-term plan. That has risk to this council and their potential risk to the ratepayers. I found out about that externally. I didn't find out about that internally. So what are the mechanisms to ensure that we're capturing all the relevant data that's going to come in here and it's been escalated in a timely manner so that elected members can be ahead of the game?
Yes. That's the importance of using that framework that we have and using that identification process where somebody has now, you've identified this is a potential risk for council and you need to bring it to my attention, and I will then incorporate it as a risk to council and then follow our framework tools to address and assess that risk, to sort of take it to a safe zone or basically show what our raw risk is about that. You understand?
Through the chair, that will come in two ways, Councillor Court. It will be a trigger in the risk framework, but it will also be a trigger in the assumptions that sit within the long-term plan itself. So there's a whole set of assumptions that go into that document that are what we base the long-term plan on. They may not necessarily be risk statements, though they're just the assumptions that we're using at the time. But I think it's important to understand that Josh's role is, as she's already said, is to embed this within the whole organisation at the grassroots level. And those workshops and those meetings need to start now that we've got the framework and policy in place. So it would be part of a meeting schedule that Josh would have had with the NTA, for example. And it would have been part of that process, but we need to make those connections once this is adopted.
So will there be a reporting back, Joshna, as you embed this to see how successful that is and if it needs to be tweaking?
I don't see why it wouldn't through the chair. This is an evolving process now. So we need to make sure that it is doing what we think it needs to do.
Thank you.
If I may comment on your specific situation, most councils have the Audit and Risk Committee considering the key assumptions and underlying risks associated within the LTP, and it's something that I've come recently into the role, and it's part of us developing a risk work plan and getting that involvement so that we have a group specifically looking at what are the risks in delivery, what are the risks in the assumptions, such as I raised interest rate risk earlier. What's the risk of isolated hyperinflation in this area and in the East Coast generally eroding because of the damage that has been done in recent weather events over the last 12 months. And thinking about all these things, and have we got the assumptions underlying our LTP correct as best that we can predict. Now, no one's that I know of is able to forecast Saturday night's lotto results, so it is the best that we can do. It's not a definitive answer. But that is a role of, in my view, of this committee, because the LTP is the single most risky document that this triennium will produce for their ratepayers. It's our key point where we interface with them and give them real choices as to the consultation questions. Do we go left? Do we go right? If we go left, what are the benefits? What are the risks? If we go right, the same, and give clear alternatives. So it's getting right down and looking at these assumptions, the risks associated with them, and making sure they're disclosed. Three Waters, for instance, we've just been hearing that the new government has committed to a change. And they made that very clear. But we have been instructed in this LTP to assume that it is status quo. Now, what happens if they announce a new way forward in March and we've gone and done all our LTP consulted on one basis? We've got some real issues here to manage that are being thrown at us from outside our tent, and we can't control. So interesting times we're in. Steve.
Yeah, Councillor Court brought this up, I think at the Regional Transport Committee, and it was brought to us as a supplementary paper in the Transport Committee meeting yesterday. And the delay she's talking about have a substantial risk to the setting of the LTP, because the delay in the National Land Transport Plan coming down to our regional transport, well, it goes the other way, what we want to do, regional back up to national, and then what comes out of that transport plan, it can delay what we can do with our subsidised funding and the financial assistance rate going forward. So we could end up having a whole lot of priority projects wanting to do if we don't notify. What's the last date? It's September, October next year, and it's that far away. So we're already beyond that date now, and this little weather event has delayed some of our construction work, but not knowing, and then actually be able to implement the works by the time we get the funding approved, know what's going on in the National Land Transport Plan, we may not get started till January, February of the following year.
Yeah.
So it's significant in compounding our infrastructure deficit. Just an example is drainage. At the current rate of spend on our drainage, trying to maintain our road drainage, we're 183 years behind, I think the number is. It's massive. So huge risk. And I think the other thing that the event that just the tail of that cyclone that trundled through here in the last couple of days, you know, that climate change risk is huge, and we'll come to that in the next paper, I think. But
yeah, we will. But this is the horizon scan, and what I talked yesterday with our CE was about getting a paper for each risk meeting about, well, I said, words I used was what keeps them awake at night, and he said very little keeps them awake at night, which is fantastic. But what are his key concerns coming from a management? So summarise all of management's what's coming at us, and getting a session where a paper will come and we can get a real understanding about where his focus is and where he sees issues coming. And guys knew he's not had the role for very long, and he will be seeing a lot of things from his wide commercial background that he's had. And again, I'd like to open up the floor then to say, councillors, what are you seeing when you put the binoculars on and scan the horizon? Great point. How are we going to react to this, that and the other? So actually really get front footing this, because if we can anticipate risks and have a playbook in place, if this happens, what do? We'll respond much quicker, we'll respond more efficiently and cheaper. That's risk, as I've used this analogy before, I think, with you guys. It's the question is, why do cars have better brakes? And that's so that we can go faster. So that's the concept. And if we're scanning and looking out there.
And I think after that Bancorp report this morning, you know, one of our greatest risks for the LTP going forward is our ratepayers' ability to pay.
Yep.
They're already under the pump.
They are. So what do? There's going to be some very hard decisions made, or have to be made, and consultations out there, because we've got to rank everything the council does and what is absolutely critical we do and what isn't there. And that's going to cause some interesting discussions, I suspect, around the council table and with our ratepayers and constituents when we consult.
Thanks, Mr. Chair. I think one of the things that I will always push, and it doesn't mean that our risks are any less, but also they're not risks that we burden alone. This country is made up of 78 local authorities, and a lot of them, and you know this because you sit on other councils as well, share the same risks that we do. So there's shared learnings that can be made in ensuring that we can make it through. Excellent point raised, an example there in the fact that the G-piece is going to change, and we won't expect to know how much we'll get from that for our regional land transport fund and plan until September, but we have to adopt our long-term plan in July, so it's like driving blind. At the same point though, there are 66 other territorial authorities who are also in the same car driving blind as us, and so there are national opportunities to connect with fellow councils, and this is something that we will be raising through Local Government New Zealand's National Council to ensure that when our new government forms, we have those conversations with our new ministers so that they understand the impossible task that we have to operate within, and when and where they can, they do need to provide assistance and changes so that we can do our job effectively and efficiently.
I agree totally with your comments, and I do sit on 4 other councils and we're seeing the same issues coming through, and thus my earlier comments. You are not alone in this. Yes, you've got your own flavours, but you know, I'm on Hastings, for instance. They also have roading issues. They've had cyclone. They've got Category 3 housing. They've got all these issues, and I know Joshua is working and has made contact with Hastings along the way to doing it. So there is collaboration happening, and I certainly, from my experience, see someone that's been there, done that, I introduce them, because there's no point reinventing that wheel. So, yeah. Any other comment? Guy, have you got any thoughts? You haven't canvassed? Pinatoe?
No, mate.
Okay. We now move back to the recommending.
He's moving back to get a get him over and second again.
Yep, and I'm just going back to find the page 16. That Miromiro Assurance Risk and Finance Committee adopts the risk policy and the risk management framework as a dynamic document. So it's not set in concrete. Steve, you'll move that way. And you happy to second that?
I thought it was already moved.
No, we haven't quite got there yet. All those in favour? Against, if any? Carried. So thank you, Josh. Go forward and make it happen. But don't go too far. You're not quite excused yet. Moving forward to 6.2, Josh, now you've provided a paper here on the risks, and that's really capturing what done under the, might have been the previous triennium, certainly before I joined this committee, is identifying the top risks, and there's been a few comments already, but perhaps walk our way through this paper, if you would.
Okay, so after we've adopted this risk reset, I've gone on an exercise to identify what our top 10 risks are at council. This is not something that was taken from previous reporting or previous to my time. I wanted to introduce what's live and topical to council for the risks, and not just take our top strategic risks and report on those, because there's some pressing risks that sit, the operational areas that also need attention to come to council. So after I embarked on this exercise of making comparisons with the other council's top 10s, introducing the World Economic Forum global top 10 risks to our elected members, I sort of workshopped, digitally workshopped it with our elected, with the SLT, and we've come up in no particular order with this top 10 as what the risks are for council. So I've eliminated and worked with them, and this is the 10 that we've come up with. I've still got to workshop this with the separate divisions and go through each and every risk in order to flesh it up so I could provide some sort of reporting on it. But because this is also fresh and it's still a work in progress, it will come at some point, but it was just not ready at this stage. So that's how we've arrived at these top 10 risks. They're not fixed, it's not in any particular order, and it's presented to elected members to show you all that this is what we've arrived at from doing an exercise with SLT.
And bringing forward all the past work that's been done. So rather than being perhaps a top 10 risk list, it's a starter for 10.
Yes.
Going back, and it needs to be worked on and continually evolved. There. So any comments, particularly from any of the committee members?
Can I just raise the one that my colleague raised? So we have heard this morning from Earl in Bangor, and ratepayer affordability has to be right up there as one of our risks. So I'm wondering, Joshna, what the ability is for elected members to workshop the risks on this list, rather than just SLT, to make sure that we've had an opportunity to input.
You will have noticed there was a workshop planned for, I think it was only for about an hour or 2 hours last week, that we cancelled because we wanted to make sure that the policy and framework were in place first. So that is the intention, is that following the adoption of the policy and the framework and the identification of where SLT landed, it will now come to the elected members to have the same discussion. So that will be the next stage. This is just us looking at what we've got in place as a group and saying this is what we can see. Where do we go to from here is the next stage.
So if I may, at this point, this comes back to this horizon scan I keep looking at, where continuously this is evolving, but let's actually put a peg in the sand. And we're, given this discussion we've had, and I'd hope that when this workshop happens, I'll be able to put my penny's worth in on it and give my 40 years of experience in this back into you guys, but also to have you guys now as Risk and Assurance Committee members giving guidance to the other councils and going out there and starting to think about where are our potential risks. And don't just think about things that can go wrong. There is a risk of inaction, of us not getting the benefit of something that we could. So there's upside risk as well. So that's essentially, just summarising my thoughts there, Steve.
Yeah, and I think the number one on that page 33 refers to the failure to deliver on capital works programs, and there's a variety of things that can occur there. But it also means the upside I see in the risk profile is actually prioritising what we're going to do, bearing in mind ratepayers' ability to pay and the funding that's available. So the roads and bridges, sewage systems, water supply, the infrastructure deficit across all those things is huge. And I'll make note of Rolf and Inga in the back room. They mention here of the failure or inadequate response to climate change challenges. And they've corresponded with a number of us, and they point to top energy as being an exemplar of how to deal with climate change and use that climate change lens on anything they do. And they're in a carbon neutral situation in their production and things like that. So we've actually got to shift our thinking in that regard, is my opinion. I'm only one man the table, I get that. But if you look at the climate impacts, 1, 2, 3, 5, 6 and 8 are all impacted by climate. Right down to 5 is failure to manage council's financial sustainability. And that comes back to ratepayer ability to pay after that fellow that's encouraging a few people to shorten the rope in the shed. Pretty depressing.
I might just add that when they are LTP, which is not going to be audited, is my understanding, because we've got an exemption given Gabrielle and where we're at, but we should still take on the factors that the Office of the Auditor General would be looking at in an LTP, and that's the 5 Cs. I can't remember them all straight off, but capacity to deliver. Climate change is one of the 5 Cs there, and thinking about it. And this goes all sorts of places, is that putting aside whether in fact it's global warming or all those other emotive things, there is no one out there that can deny that our weather patterns are changing right through the country. Things are changing. Back when I was small, I used to ski at the Miromiro Ski Club. That there, you can drive through the valley there, and if you're in midwinter, and you can look at a patch up the hill where there's no tussocks, where the lift line used to be. Whether it's cyclical or whatever, but things are changing, and we're getting more weather patterns, more adverse things is what I'm seeing. So it's got to be right up there in everything we do, and keeping our network resilient, keeping our people safe, thinking forward about
just because of our geology.
Yeah.
Our infrastructure was because of our geology.
Yeah.
A lot of
So
clay soils and yeah, and reclaimed land.
John.
Just a comment. I'm probably getting a bit concerned that we're getting paralysis by analysis because a lot of really council is here to deliver results, and all of the risks, which are many risks. So I'm not what's been conversation that's been said. I think it's absolutely crucial, but we are to deliver an outcome, and so a risk really is of all stuff if it's going to hinder us to delivering that outcome, or it's going to make our people sad or hurt, and all of those things. So that's how I see it. That's, I'm sure Josh would realise that as well. And so when you look at failure to deliver on the capital works program, the LPP, which is our promise to our ratepayers, there are many things. There's climate change that does that. There is the financial, our financial well-being, if you like, affordability, but also the timing, as Councillor Court pointed out. And we've captured that when we look at our failure to deliver on capital work. So here's the question I've got. There is a question on all of this. Is a lot of these, while they're summarising effectively a whole bunch of potential issues that can occur, they need to be broken down into actions that are occurring through the CE that is mitigating and applying treatment so that we are aware of things that may happen or have happened, and therefore how can we ensure that we are doing the delivery. That's why I see the whole risk committee being really important, is to look at right across the spectrum, see what's actually potentially out there from all the sources we've got, bring to our notice around the table, to the notice of council is what's critical, because there may be a governance decision needed, and of course on a daily basis to see, looking at that to ensure that it's maximising its delivery in the most economical way and affordable way.
At the end of the day, if we fail to look at those items, page 31, the ones we identify in the red area, particularly and possibly some of the yellows, we will not deliver to our ratepayers what they expect, and we will lose our social mandate to be here.
Yep, that's right.
And that's an election risk for the councillors, but more specifically, if we get offside sufficiently, we will find commissioners being appointed, and we don't even want to get remotely close to that situation.
Yeah. But councillors getting elected shouldn't be a risk to council.
No, correct, but that's the ultimate where the ratepayers say we are not satisfied with what you're doing.
It could be a risk to council depending on who gets in, John.
Yeah. And some might say in the council sector, me as a non-elected member, that the election is one of the council's biggest risks. But anyway, I won't go any further in that territory. So, any further questions or comments on the top 10?
Only question I had, and I believe we discussed, our organisation, there's listed governance as a big risk. And governance is more of a, the governing bodies, including us, I guess, the governing member, as well as central government. Right now, there's still that discussion in terms of future for local government. That has the potential to really change the structures around significantly. I think it hasn't happened for 30, 45 years. And you just have to look at that, because that has all sorts of ramifications. If an organisation doesn't exist, surely that should identify it. If there is an event that can result in an organisation not existing, surely that's a major risk.
Yeah. John, are you referring to the future local government report, the Jim Palmer's report?
No, I'm speaking more generally, and that is the government's direction to looking at changing, because they, for various reasons that we've heard, changing the structure of local government to be more effective and more efficient, whatever that is being
And
used.
this district de-amalgamates is the district.
Yeah.
Suggesting that depends on the national government's stance with free waters, because we might not be changing at all.
The discussion for the structure still going on. And that I think needs to be considered, but that's part of the bigger whole suite of risks to talk so.
If there's no more discussion, we have a mover and a seconder. I'll read the recommendation that the Miromiro Assurance Risk and Finance Committee receive and note the top 10 council risk report. All those in favour? Against any? 6.3, and I don't think you get let off yet. There, and Jonathan, is there potentially, given the audit role of CFO, could I perhaps impose on you to pop up here in case there's questions that you can provide some update as you're dealing with the auditor on a daily basis at the moment? As Janice has just pointed out, it might nearer be hourly. So, Josh, your paper, I'll hand over to you to introduce it and pass any comments.
Okay, so this report here is it's filling the gaps between Audit New Zealand Deloitte's taking over the external auditing, and there were some observations that were made by Audit New Zealand prior to the takeover, and I just what we wanted to do was to identify if there's any gaps that are would be lost in that takeover or that transition. And so we've done an exercise of going through each of those observations and in conversation with Deloitte, so they also know what those observations are, and we've brought it to their attention, and we've driven internally where we're sitting at with those recommendations that were made, and produced this report.
Perhaps if I might ask Jonathan that this topic did come up in passing in the meeting we had with the audit partner last week, and you might want to just pass on really how they are seeing things at the moment with regard to the past recommendations.
Sure. From discussion with Deloitte, they were given a handover from Audit New Zealand in and around the historical issues here. Obviously with a number of passing through recommendation for closure, but in case Deloitte's had an obligation in order to go through each of these in detail aspect to ensure that the relevant actions have been put in place to satisfy themselves. What they will look at doing is forming that opinion and passing that through into the next management report from Deloitte. As far as their initial views, some of which are actually contained in a late paper that was passed through to this council. I think it's on the agenda later on today in PEs. That's the bulk of it at this stage.
So we've got 17 items here. 4 are labelled, in your view, as being open, and Deloitte are going to come through and effectively confirm that they are happy for the other 13 to be closed. But is your view internally that we have done what's needed?
That's correct. That being said, there have been new recommendations which they have raised, and that will continue to raise as the audit progresses. These are fresh eyes, and in many ways is a good thing for council to obtain a new set of views from our new set of auditors.
Yeah, and a bit of background for those that might be listening in, that the Deloitte took over the audit last year partway through the audit process. So they picked up the Audit New Zealand work and finished it due to the issues with staffing that Audit New Zealand faced with the border closures, COVID and everything else. So this is really the first full cycle audit that Deloitte's have had an opportunity to really stand back and look and tidy up these matters. So we have got a paper in with some interim observations. So this is a list that we hopefully cross them off the top, and there will be add-ons on the bottom. So it's a journey. We don't even get to the destination really on this. Is there any comments from councillors? Steve, you're looking like you want to raise a point.
It's more in the adding pages 39 through to whatever it is, 42, I think. There's just a couple of questions I had there. One was around the property, plant, and equipment capitalisation, and it looks like it's all been increased, but it's just there's questions there around the valuations and then assets that weren't valued because it's done on annual basis. And just the recommendation there was from the managers to actually give our general manager or the team involved in it to give an update on the, what's the wording there? Review reports and advise of any material issues that may affect the impairment testing, so any assets that may have failed. Another one, probably plant compliance with, I'm not sure what it means, PDE IPSAS 17. And just council review its disclosure to address these deficiencies identified in the property, plant, equipment note of the annual report. It states that it's the management's responses. It looks like they're looking at that. Significant projects. There was two comments in there that I just wanted management's response. Project governance. It said there was a portfolio governance authority framework being established, but was suspended by the CEO in 2022. And then further down, procurement, the CEO has since 2022 disestablished the tender panel, which was designed to review any high risk, high value procurement, which was if there was an exception to procurement policy. So just there's a few comments like that I just looked at and was a bit concerned with.
This process, if there's a wee bit more happened at that online meeting, and that they've indicated that they're going to go through this information and really bring a good view to all these responses back, and we'll see it at the February meeting. So I am wondering whether that would be a better time to go off when we don't have the auditor's assessment of past items. But I'm happy to, if councillors wish to dive in further, but I do wonder whether a rain check may be appropriate.
No, happy with the rain check. I just, what I've noticed in the last one's on page 42, it refers to carbon credits, and it talks about council brought carbon credits to offset annual emissions return, and then those carbon credits have been removed from the emissions trading register. I just wondered why that was, because we've got forestry assets as well, and I'd just like a bit of an update on that. It's fairly topical. Buying offset to offset your emissions. Just need some more information on that.
Through the chair, that would have been in regards to the two landfills that were previously closed, and once they were closed, no carbon credits were no longer required. We do hold pre-1990 forestry assets in Kaikoui, on which we were gifted carbon credits accordingly for that, which we still hold, although they are at zero value on our book, given that anything or any credits that are not used are returned to government. So therefore they cannot be sold or traded in the carbon credit market or through the emissions trading scheme.
So that's a standing forest. So there might be a carbon credit liability when you harvest it.
If you don't plant it, yeah.
If it's pre-1990, if you harvest it, there'll be carbon crops. So you need to look at the risks associated with that. And we can discuss the detail.
I can tell you that this whole area is a major issues sitting out there in the wider council sector, because some councils have significant forests, and the accounting for this is not clear out there, and the standards have not kept up with action, and complicated by the fact that we're using international standards, and every country in the world is taking a different approach to carbon credits. And so, yeah, it's certainly something I'm very actively involved in at a higher level, and talking, in fact, later this week with the Auditor General on the topic.
I know that Councillor Peskovic has hands-on experience through his involvement with carbon credit and the emissions trading.
I see that the camera has gone on, and open the floor to you, Terry.
Kia ora, thanks, Graham. Look, I just want to know from through the chair, how many credits does the council actually have for the pre-1990 forests?
Will we be covering that when we look at the draft annual report? You disclose it on somewhere in there, do you?
I'm asking the people who are sitting in there that were just talking about carbon credits, how many credits do we have? The pre-1990 credits, we don't have any liability, and I just want to know why they've been taken off the emission trading register and why they're sitting there at zero value on the books when they're worth about $70 each.
Through the chair, they haven't been taken off the register, they still sit on the register. From memory, it's about 1,500, but I'm not sure, without looking at the register, that that's the actual number. Because they're tied to pre-1990 forests, if we deforest and don't replant, those carbon credits go straight back to the government because we didn't buy them in the first place. That is a condition that was placed on them when they were put into our hands way back, probably 10 years ago, when the ETS scheme first stood up. So they're not tradable in that way because they're tied to those forests.
If I can perhaps provide a little more, try and make a technical thing in plain English, the valuation of our forests assume a single cycle. So they do not, in the valuation process, factor in the purchase of carbon credits on deforestation, and therefore the assumption is that we are holding them. So if we valued those credits in our books, we would have to write down the value of our forests as well because of this inherent assumption. And this is getting to the heart of the issues associated with forestry and ETS accounting. So yes, it's a bit of a muddle at the moment, and even between councils that I'm involved in, there is different accounting there because there is so little guidance, and we are imploring the Office of the Auditor General to actually assist unfortunately the external reporting board that sets the standards in New Zealand's not interested, so we need to get some sector guidance because this is a very big item for many of our councils, and to get real clarity about what we can and can't do within the rules and what we should and shouldn't be doing, also within the from our social mandate regarding climate change.
Well, yeah, no, thank you, Graham. That's great. You make note about that, because the new legislation under the NESPF, which is going to treat carbon forests the same way they do commercial forests, means that the government wants to provide local government representatives with the tools that can curb forestry conversion of farmland. So it's quite timely. That's another thing. Also, just speaking on that issue, and I see our CEOs in here, just talking about forestry, guys. We've got the forest out in Hokianga, which for about a year ago, up until about a year ago, I was made aware of it, and where the trees are well past the time where the harvest stage. And it's probably a good thing for us to start looking at that. I mean, even the issue around the Kaikoi wastewater, where they were considering buying land. I mean, a good option for this council is the good option for this council, if we are looking to land-based discharge, is to find land where we can discharge to, and then plant that land out in pine forestry, so that we can generate some revenue off it that can actually offset the costs associated with the refurbishment or the cleaning up and tidying up and fixing up of our crappy wastewater infrastructure. And I can tell you, Mr. Glynn, with certainty that for the next 3 years there'll be no changes to the ETS settings. They will be remaining the same. There's two things the Crown want to do. They want to either increase the value of carbon so much that that people will be dissuaded from continuing to emit pollution, or they alternatively want to crash it. Andrew Hoggard, guy from that party, and Butterwick, bloke from National, they want to bring the price down. So they want to crash it because the farmers aren't interested in any further conversion of forestry to farmland to forestry. Cheers, guys.
Yes, it's certainly a rapidly changing area, and it would be really helpful if we had some certainty as to the accounting. Because of course, despite all these other values that are sitting there, we are bound by accounting standards, which are pretty much out of date at the moment in this area. Any other comments on the report? In which case, I shall go back to the recommendation that the Te Miromiro Assurance, Risk and Finance Committee receive and accept the report on historical order observations. Panatili, are you happy to move in that direction? Excellent, thumbs up. Seconder? Yep. Thanks, John. I'll place the motion. All those in favour? Against, if any? Carried. We're now moving to item 6.4, which is on page 43 of our pack. And have we got Janice, are you going to speak to this paper, or?
I will speak to Jonathan around here.
Come and join us at the table. Feel free to carry on. We're just doing a little bit of logistics planning here.
That's right. So this report is for the end of September, where we've updated the commentaries where required. So I will be just going off the financial overview on page 47. So we've had an overall net operating position of 11 mil. Just a general comment, there are still a number of budgets that are being timed, which the finance team is going through with the departments, in particular roading, which you will see throughout this financial report. So we have had year-to-date total income is ahead of budget by 15.6 mil. The main drivers for this has been recognised within other income and contributions in terms of grant funding being received, petrol tax and our interest received. Also year-to-date operational expenses is currently also ahead of budget by 4.7 mil. This has been largely due to our contractor fees and external services. There are a number of scheduled works which are in progress in terms of water, wastewater schemes and solid waste. In terms of capital, our capital program, we are ahead of budget by 2.7 mil. But also, again, this is due to we are still needing to retype the budgets of particular roading. Okay, so there are a number of projects that have progressed to date, which you can also see throughout reading the report. However, overall, when you look at the full program of 155 million, we are lagging in that space. But again, finance is working with the departments to try and make that a bit more palatable. In terms of borrowings and investment, we are holding a cash position of 19.2 mil, and we have a current drawdown on facility of 12 mil. Comments, questions?
You referred to an increase in expenditure, and one of the comments you made was external services. Where do I find who that's paid to? External people?
External services, that's on page 51.
Professional fees?
Oh, you're wanting professional fees?
No, is it showing professional fees?
No, professional fees is separate. That's the page before.
Oh, okay, gotcha, sorry.
Any further questions?
Professional fees for wastewater. This council's just considered quite a lot in the wastewater space with the resource consent renewals for the Auckland or Marketing Wastewater Treatment Plant, Honolulu Wastewater Treatment Plant, and the Hapu Working Group doing their preferred option for the Kaipuni Wastewater Treatment Plant. I'm guessing it was all done in-house while we have wastewater professional fees under budget in this space, or it's been within budget. It just seems that we've got a lot of work on in that space, and to be under budget is, well, it's a good thing, one, but it's just an observation.
I think I'll come back to a lot of the budgets are still being retimed. So once we get through, we go through an exercise at the moment. So in the next report, we should have more clarity around where the budgets sit.
Thank you. Sorry.
I think that's, I found it, but I was looking forward. The external services, roading network external services over budget by 2.2. This is due to CapEx timing, which hasn't been loaded yet. When is the CapEx loaded?
So usually with roading, there's always a progress in terms of when we're doing the finances with them. So we are looking at getting everything done in this month in October.
So is that a delay from NTA?
Sorry, we have to come back to you on that one.
Okay, thank you.
This is to September, right?
Yeah.
So we just voted to increase the funding for our swimming pools. It's under budget up until September, but in the last council meeting.
Yeah, we should be now seeing, now that decision's been made and we go through the reforecasting, retiming exercise, this will start, the report will start aligning a lot better. Yep.
And just one other thing relating to our debt or equity position and what we can borrow relates to something that Councillor Ford asked of Earl. Landport Drive, what is our actual, what's our debt ceiling? He gave us specific indicators around, he referred to Treasury policy, I think, which you have to stay under.
Yeah, so in this case, our debt ceiling is currently at 299.8 mil, which our policy maximum is 126%. So if you look on page 54, that will give you the summarised update in terms of our net debt.
Any further questions from councillors?
that, I didn't think I did, but that's just raised a question in my mind. So our LTP forecast our net debt at 2031 at 331 million, which is 32 million more than our current debt ceiling. Does that raise something that I need to be concerned about?
When do we get our rating and it goes up?
Through the chair, the 3031 debt ceiling would be based on your income levels of 3031. So this is based on your income levels now.
Okay.
So that will progress over time. So the two things move together.
Okay. I think we need to be a bit clearer about that in our LTP. It's not clear to me. It's certainly probably not clear to the ratepayer. I know it's probably something you understand because you even open your Weetbix box in the morning thinking about me.
I'm concerned, Ian, because you're the most fluid councillor for all of this sort of stuff, in my opinion. And if you've got concerns because you're not getting it, then what show do I have as the mayor? So I would very much like clarity in that space as we go through LTP.
Any further questions or comment from committee members? Okay, on that basis, we have a recommendation that the Te Miromiro Assurance Risk and Finance Committee receive the Far North District Council financial report for the period ending 30 September 2023. John, are you happy to move in that direction?
Yep.
Thank you. Are you happy? Second? Thank you. All those in favour?
Right.
Against, if any? Carried. Just looking at the timing now, we have to work in with our auditor, who is joining us in the PX session, and 31st of October is not a great day for council auditors because it's the final day for adoption in theory. So he's somewhat busy. I'm suggesting, given that we're just after midday, that we rearrange the agenda and we go into PX now, and then we come back out of PX and deal with items 6.5 onwards with to 6.8 within our open public agenda, just to facilitate being able to have our session with the auditor, because he has a number of other commitments today with other councils. So on that basis, we have a resolution to exclude the public, which will need a little bit of tweaking. The first item is confirmation of previous minutes in the public excluded, which I think is self-explanatory why that should be there. Second item we'll be covering is cyber security and system availability risks. The reasons for that is that if we publicly talk about where potentially we've got, that should not have done that. It was in do not disturb mode. So my apologies. If we talk in public agenda about where we may have system weaknesses, this of course is an open invitation to a cyber hacker to come and exploit them. The third item we have here is the current legal actions list and potential liability claims, and that is on the basis of maintaining professional legal privilege. And the other item is the annual report and the auditor discussion, which is under section 7 sub 2 C2, and which is about withholding of information necessary to protect information which could be subject to an obligation of confidence, etc., and to allow a free and frank expression of opinions, which is section 7.2f. In essence, we will be looking at an annual report which is still work in progress and is not finalised, and the numbers in it are likely to change. So to be publishing information which we know may not be 100% accurate to our ratepayers is not aiding in decision making at this stage. We will also be having free and frank discussions with the auditor, talking about where the audit matters of judgment are and where matters are that are not finalised. which again may release information into the public arena which is not accurate. I note that as soon as the annual report is published, which I believe is 7 December, all of this information will end up in the public arena, and that is timely. So on that basis, do I have someone?
I just question that when I haven't read the entire annual report yet. I've given a good bash, but it's a pretty meaty document, and we've had a lot on our plate. A question arose in my mind: why is it in appendix? Now you've given us an explanation. I'm not sure that satisfies me. Because it is a draft, it will be subject to change. It will be subject to material correction. And is that sufficient grounds for it to be a appendix item?
Certainly my experience with other councils indicates that we shouldn't be releasing information that we know is incorrect, potentially, and we do know there are substantial areas within these financial statements that have not been finalised, even by our own in-house council team, and therefore people will, what is material is if information, if it is wrong, will potentially cause someone reasonably educated to form an incorrect basis for a decision, is really the definition of materiality. And so therefore, if we are putting out there information which we have high reason to believe is inaccurate, ratepayers then may look at this information and form incorrect views, which could actually not be helpful to allowing proper decision making. So that's always been the basis that I have dealt with. I'm not a lawyer, I'm not an expert on these sections, but that's usually the rationale, is that we do have an adoption date. And I do note that today is the date under legislation that we should be adopting, but quite simply our financial statements through all sorts of things in Cyclone Gabriel, staffing changes in accounting standards, we're just not there. And we've got a new CFO who's trying to pick up and do a sterling job. We've got Angie and the team have done really magnificent work, but despite best efforts, we've not made it.
I'm just going to ask a question because there's nothing in the report which would suggest that there were material errors in the draft.
However, I might just add, if I cut across you there, apologies, but the auditors haven't even looked at it to define a view as to whether it may be materially wrong. We're just not at a stage where it's been subject to any scrutiny, and there are still
and a statement being made that there are material errors in the draft.
You missed.
Financially material errors, and so without, I'll leave it at I'll keep my comment for PX.
The comment that I made is that they may contain. We have not had the assurance yet, and even our internal teams have not got to a stage they can give us assurance that the information in there is totally accurate.
I'm just going to say again, I don't think that's sufficient ground to keep it in PX. I think as long as that disclaimer is made publicly, that covers us. I'll leave it at that.
Can I just start to comment on the next steps for this and when the public can expect to have the annual report available for their perusal, not in a document like this. We plan to adopt this at our December meeting for council. And we will have another assurance risk and finance committee before then in the
virtual one with the one topic. Yeah. And I guess it becomes public at the point that the papers for your council meeting are issued. So that'll be somewhere just before the 7th. So is that my understanding?
Correct. Through the chair. This isn't unusual to have a draft in PX. We've had a draft in PX every time we've brought one to you in the last 5 years. The issue is the auditors are continuing to work with us on issues. We've had emails while we've been in the meeting today asking for information. Once they finish, it then has to go through 2 peer reviews, so through the audit manager and then through another peer review that could amend any of the decisions or discussions that we've had to date. So it is a risk if it's in the public space at that point without those discussions having taken place yet.
Even with a suitable disclaimer that until we adopt it, that is a draft. Any draft can change. Under what point in standing orders are we using to receive this information?
It's under the Local Government Information and Meetings Act 1987.
Oh, sorry, which section, the different stipulations which allow us to consider?
Section 7, I read those out before. Section 7 sub 2 C2. The withholding of information is necessary to protect information which is subject to an obligation of confidence or which any person has been or could be compelled to provide under the authority of any enactment where the making available of the information would likely otherwise to damage the public interest. And the point is that people will, if the information is incorrect, they've got the wrong information for them to be making their own assessment. The second one is, which is more when we get the auditor actually online and speaking, to allow freak and frank expression of opinions by or between or 2 members or officers or employees of local authority, because we may well end up commenting on particular issues which may be subject to legal privilege. It may relate to individuals and the way that controls have been exercised by individuals, so we have a privacy issue. I'll also draw a parallel to the public company environment, whereby there's an obligation for them to keep the market fully informed at all times on anything that affects or is likely to affect the price of securities on the issue. And there is very definitely, until the company and the auditors have finalised the accounts, the precedent is that there is no announcements made other than general financial statements. If a company enters into a transaction which is of market significance, they must announce it, but not at releasing the financial information. And I think our Chief Executive has passed to JP Morgan. I think it was, will reiterate that. And so there is plenty of precedent inside the sector and outside for this approach to be taken. Yeah. I haven't read the Ombudsman's report cover to cover. I've scanned it, but I have not seen, excuse me, any comment in that.
Thank you, Mr. Chairman, for the explanation. And our residents can dutifully await the public sharing of our annual report and our agenda for council's decision making.
Correct.
Actually, if I could just set your mind at ease, I think it would be a significant departure from normal processes to issue a draft or make it public. And I think that applies to any public entity, whether it be a public listed company, a council, or a pension scheme. I used to be a trustee of a large pension scheme in Europe. Certainly we would never release a financial report prior to sign off by the auditors, management letter being issued.
I also highlight, we've just been through in the previous item, looking at our results for 30th of September, which is even more up to date in our management form than the 30th of June information. It's just the detail level and the level of assurance that comes with it that we need to be somewhat careful about when processes have not been completed. But that's my view as chair, but ultimately I've put a resolution out there. If we move it and second it, we can open it for further discussion. Are you happy to move? Steve, you're happy to second? And at this stage I'll open it for further discussion if you've got any sort of further points, Councillor Court.
This is prior to moving into PA.
Well, yes, we haven't got there yet.
Motion to.
This is the motion to.
And you're opening for discussion. Yes, sorry, who moved? I got the second. Thank you. And John.
Any further discussion? If there is no further discussion, I will post the motion. All those in favour?
Aye.
Against, if any? Carried. Straight into the revenue recovery report, are we?
You're in.
Have we got the appropriate people here? Yes.
Yes.
Come join us at the table. That is 6.5 on page 58. People who are needing to navigate, like myself.
Good afternoon, everybody. Before I start on my report, I just wanted to note a few changes in how the report has previously been set up. As you can see, I am a very footnote person. It makes following the report a lot easier when you know what actual table you're looking at. I did take some recommendations from the last committee meeting to give a comparison to where we were from the prior year. Unfortunately, due to the onboarding of our new elected members last year, the first Te Miromiro committee meeting was held in December instead of October. So there is a slight discrepancy with the numbers, but I am open for suggestions and more recommendations of how they would be like to be viewed. So since the 1st of July, the general title rates total arrears balance has increased 42%, and the water rates has increased by 7%. Of these properties, it shows that under debt recovery action to commence, 33% of those properties have last year's rates in arrears and 19% have 2 years of arrears. 47% of these accounts have arrears of 3 or more years owing. With the multi-freehold lands rates and water debt, the rate debt has decreased by 1.5% since the start of the year, and of which 9% of that was for multi-freehold land remissions, and also the multi-freehold water rates have been reduced by 15% as well. With the sundry debtors debt, there has been, during the reporting period, there were several significant diverse invoices that were raised that did skew my reporting numbers for sundry debtors. As if you look at footnote 8.5, it does show that the sundry debt is 33%, and that is because of those 2 invoices that were raised at the beginning of the new rating year that were delayed in payment but have now been paid. So the key actions since our last report, as recommended from the last committee meeting, the revenue recovery team called, what was it, over, under, sorry, so that is footnote 8.2 in the attachments. There were 5,606 accounts that had not made any payments to instalment 1. Of those 5,600, revenue recovery made contact with 1,954 account holders. On the table of 8.2, I did do a breakdown of percentages and categories for those that we had discussed with our ratepayers, and that was to gather data of what actually is going on within our communities, and, you know, was it something that we can look at going forward. We were advised that a lot of people actually just forgot. That's realistically what it comes down to. They forgot that it was due that date. There is a significant lot of people that have advised that they would pay, they'll make payments, they'll set up arrangements. Prior to this, I have gone through those accounts, and a lot of them just have not made those payments. That when we've had that discussion with them, we've tried to encourage them to set up a payment arrangement. Our team have pushed it out to our maximum 3-year term, and the paperwork has all been sent to them. We've just had no replies back from that. So it does look like with this data that people are financially struggling, and when approached, they are doing the yes, we will pay it. But by the looks of things, unfortunately, that is not correct.
Approximately how many rating titles?
So from what I've gathered,
Just to put it in perspective.
so perspective would have been at least 25% of those that have said that they will pay, or they're going to make the payment, or set up a payment arrangement, have not.
So 25% of the 1900 contacted.
Yeah.
Or the 5600 unpaid.
So that will be over everyone. So we've gone through everything that the underpaid.
Well, either way, even if it's just the, say, 2000 contacted.
Yeah, so 25%.
Of that is 500 families.
That have not yet made a payment or set up the payment arrangements.
It's quite concerning.
It is quite concerning what is happening in our community. The cost of living is affecting everybody. This was just so we could gather that data, so we are aware of what is actually going on within our communities.
The amount of outstandings is really very significant, and we've sort of got an issue morally between this. We've got the people who are getting the benefit of it but not paying for it, and then where other people are effectively cross-subsidising, but they're just physically not capable. So where do we go? And the admin cost of doing all this is significant. The funding cost, it's almost a number that non-collection needs to be factored into the cash flow projections for the LTP, because otherwise we will be budgeting on doing work on the basis of receiving money that we're not actually going to realistically receive in perhaps the period that we're anticipating it. This is, to be honest, of the 5 councils I'm on, this is the most concerning as far as the level of outstandings and how we function. It's got major impact because we're having to borrow that money, so we're funding it. Adding penalties on straight away does not necessarily, doesn't make the problem go away. It only actually adds to it in some respects.
No, it does. So
what about the balance who were unable to be contacted? Did you say 5,600 unpaid, 1,900 contacted?
So those that had not made any payments for instalment 1 was 5,600. So the revenue recovery team were able to contact just under 2,000 accounts. There were some that there is no contact details on the accounts whatsoever.
So 3,600 households we can't even reach or know if they even got their rate demand?
So based on that, if there is no returned mail on the rate account, we can't prove that they are getting it, but then again, we cannot confirm that they aren't getting it as well.
there are time limits on commencing actions to recover rates under the legislation, which the exact numbers escape me.
4 months overdue.
Yeah, but again, after it goes out so many years, we get a preclusion as well.
6 years it becomes statute right.
Yeah, I think there's a date before that, but from my recollection, another council. But is there? I guess I'm leading to what's the impairment? Because one of the things we need to make sure is that we're realistic in our expectations about recovery and when it's going to be.
So, through the chair, sorry. Realistically, we have started to look at the pre-calling for mortgage demand a lot sooner than we normally have done prior years. The team have started those reportings for us to start pre-calling from the 1st of November to give them that notice that this is what we're going to look at doing, to set up a payment arrangement before we get to that mortgage demand process. We're also, with that, we have statutory demand proceedings currently still occurring with Law North. We also have the submitted applications for financial assessments that are going through the court system at the moment as well with Law North. And just recently have we had our CE sign affidavit to go to the High Court to start the proceedings for our rating sale that was approved by Council in June 2023 this year. So we are trying to start that recovery action, but at what detriment to our communities.
What percentage of the 1900 contacted, were any of those implicated by the revaluation which potentially skyrocketed their rates, and until we went through that process balanced it out?
So based on that, we did have, there was just, it says 0.7% that were disputing their rates increases. But when we did speak to the ratepayers, they did say the rates.
Oh, sorry.
Yeah, the rates are astronomical. And why are my neighbours cheaper? We get all those queries, even though we're trying to be the nice people and encourage them to set up payment arrangements that are more affordable, where our team are offering rates rebate applications for those that would normally never consider it. So it is a bit of a stuck in a hard place between the rock. You know, we want to go forward, but we don't want to come across as, you know, we don't have that empathy for our communities.
Ideally, where there's a mortgage, we going down that route, because effectively then the ratepayer is financing their rates via their mortgage as opposed to us financing that cash flow at the expense of all ratepayers. But it's a really difficult one. How do you show the empathy and yet do the right thing for the ratepayers that are paying? It's one of those ones, whatever you do, it's wrong. Really, in someone's eyes.
And unfortunately, we get those all too many times.
Yeah. Apologies if it is in your report that I must have placed it on this slide.
That's okay.
Of this percentage, how many of those, were any of those awaiting the outcome of rates rebate?
No. No,
I don't know how to proceed. I just looked at some wait time this year or
okay, I can't unfortunately speak to the rates rebate application timeframes. That does sit within another department, but Janice.
I probably can. The wait time or the numbers are no different year to year. It's just that because the rate rebates open in July, all of those that apply annually, because we have to process them annually, we get a flood at the start. So we encourage people to continue to pay, and then if they have overpaid, then they get the refund of the rebate at the end. It's unfortunate that even those that are regulars, we have to do the process annually. But the numbers really don't vary that much. There's a massive amount coming in that first month that we then have to process, and we have to batch them and mail them down to the DO.
Thank you. Councillor Court has another prior commitment. I can confirm that in her absence we still have a quorum.
Yes.
I just noted a great increase in the building and resource consent. The 90 days and over's moved from 500,000 to $1 million. And maybe it's an item for management to look at the terms of doing deals where it's user pays, whether we need to revisit that the basis of how we bill and how we collect. But I'll just leave that as a comment, given that I'm aware there's a workshop shortly and we've still got a couple of items outstanding.
It's okay. Through the chair, I can briefly touch on that. The building debt has actually dropped compared to what it has in previous years, and that is from the new processes that the building team have brought into place, that now everything is prepaid. And with the resource consent, yes, unfortunately that has increased, but we have been working with the resource consents team, and now with the appointment of the new manager of the resource consents team, we are looking at implementing the same changes to the resource consent to be prepayment as well.
Thank you for that clarification. Any other questions from? Not. Thank you.
You're welcome.
The recommendation is that the Te Miromiro Assurance Risk and Finance Committee receives the report revenue recovery as at 30 September 23. You happy to move that way? John, second. All those in favour? Against, Penny? Carried. Thank you so much for all the work. It's not an easy task in these times, and it's probably not going to get any easier based off the Bancorp presentation we had earlier.
Thank you.
The next item on the agenda is Health, Safety and Wellbeing Report.
How to recruit talent.
Sorry?
How to recruit talent. There might be 15,000 public servants looking for work. We might be able to get some.
Yeah, there might be a few people wanting to relocate from one shortly.
Okay. Thanks for having me today. Health and safety reports. Ian Wilson, most of you will see me around at some point. I'm currently covering Jill Cole's position as well during the process. So the point really of this report is just to highlight to council any risk that we are carrying from a health, safety, wellbeing perspective. And I think probably the easiest way to approach this is just to go straight in and ask the committee if they've got any questions that they'd like to present to me around this report. It's an improved. There's been a bit of an absence of a report for a while, so I reviewed this report and came up with what you see now, which I believe is a more meaningful report than what committee has been receiving in previous years. So if there's anything specific you'd like to address.
Anything questions members wish to raise?
I think it's a great report. It didn't know we didn't have these speeders, but anymore. No questions.
John, you want to go?
My question is, you highlight a risk there of no overlapping duties framework. Can you just explain what that is for me, please?
Yeah, sure. So every organisation that council touches on, there's an overlapping duty under the Health and Safety Act. And depending on how far that overlap is, will dictate how much duty council has specifically. So, for example, council and FNDC employees, right? We've got 100% duty over the health and safety and well-being of those people. But say if you've got an organisation like Ventia, that we have an alliance agreement with, we've still got an overlapping duty with that organisation, but Ventia have their own high-level health and safety processes in place. So what we don't have and what we need to have is a physical framework, which is basically a list of all the organisations that we touch on, what our touch points are, and then what our level of duty is in association with them. And then we kind of know quite clear where we stand in our responsibilities, basically. So we don't physically have that at the moment. And it's a project that is going to take a bit of work because it will actually needs to be written into the contract that we have with any of these organisations. So it was highlighted during the conversation with Mike Cosman, who's the gentleman that's going to be coming in to talk to the elected members in a few weeks' time, I believe it is. So he's going to come in and give you an overview of your responsibilities and the knowledge that you need to have as elected members under the Health and Safety Act. And one of the questions he asked me whilst we were sort of arranging quite what he was going to talk to you about was the maturity of our health and safety system within the organisation, and he was interested in sort of levels of risk and that kind of thing. When I showed him through the system that we've got in place, that was one of his questions. He said, it seems to me that you don't have that formal framework around your overlapping duties. So that's that's where that actually arose from. Does that explain it? Ish?
Yeah, it's pretty common. Any other questions from members before I chip in with a few?
Just, I'd like to have all those drivers that have been over speed in our next roading committee meeting when we're talking about speed review. Because they clearly don't want the speeds dropped. Most of the other speeds are in the 80, 50, 60, 70 and 80. Carry on, Graham, sorry.
That's okay.
Can
I just pick up on that? So I sort of pull those figures in our report on them. That goes through, because this report is very similar to the SLT report. So the group managers and the managers ultimately are aware of who the people are that are doing those speeding things, and then any sort of conversations need to be held by those managers.
That was incredible. I'm pleased I don't have a GPS in my vehicle.
A few observations there. One, you've just reinforced the fact of what my optician told me, and that I need stronger glasses, because some of these graphs, maybe if when you cut them in, you can make them full page width, would be wonderful. Because I was struggling to read them, to be honest. And I am 2 prescriptions out, I'm told, so it's probably me. The speeding ones there, I guess it's getting some context. Is this because there was an overtaking lane and there's some trucks and someone beat the feet to get past them safely in the overtaking lane, or is this actually on a piece of open road or regulated road, and there wasn't sort of a mitigating circumstance, I guess, because you know, we're all hearing that speed is a problem, and some of these are quite considerably over the limit.
You never know,
So-
the new government might put the speeds up and then.
Yeah, and I guess if it's an overtaking lane and people are trying to get past to stop a problem, that's one thing. Anyway, I also had on the threatening behaviour.
Yep.
Are you having problems up here with what I'll call the sovereign movement?
That's been an issue for council in the, I've been here 6.5 years now, and the whole time that I've been here, we've struggled with areas of the community who fail to recognise New Zealand legislation, and so it's not just sort of a, yeah.
What I'm seeing at other councils is disruption to meetings and issues with theirs. So do we have a situation if there's going to be a public meeting that there is consideration of the venue and the ability for the elected members, etc., to exit safely out of an egress? Because there was a situation in another council where the only exit was straight through the middle of the problem. Are we considering that in our venuing?
Through the chair, we have in the past, especially here.
Yeah.
A couple of meetings here that have been challenging, and we have definitely had that consideration through the.
Thanks, Guy. Okay, that was really my couple of quick questions. We have a recommendation on this report, and I'm conscious that time is clicking on. It's in the papers. Do I have a mover? John, seconder. Steve, all those in favour? Against, if any? Carried.
John and Steve.
Yeah, John and Steve.
I've got somebody to read it too.
The lucky last item on the agenda is the level of service report 6.8.
The one I thought we were on,
yeah,
which
sorry,
is
6.7.
HR update.
6.7.
Turnover.
I was too quick in ticking them off. My apologies. 6.7. Who's talking to that one?
Well, I'm here. I'm kind of in that role now, so. I'm also first day back from 12 days leave. I can take any observations away with me if you've got any questions or queries around the People and Capability Core review report, and I can give you a response.
My observation would be that the issues that you're having and reasons for staff turnover, etc., are very consistent with other councils that I'm on, and issues just with financial pressures, people having to chase the money up here, partners relocating is common in more regional councils I'm on, where work opportunity can drive it. So I think I don't see anything I'm not seeing anywhere else, unfortunately. And it is what it is.
Yeah, recruitment is always a challenge, I bet.
However, if someone quit before, there might be 17,000 civil servants in Wellington wanting to relocate shortly. So, if any other questions from members? In which case, we have a recommendation here on page 71. Who's happy to move that? John and Steve. All those in favour? Against, if any? Carried.
Yeah, John, I think I'll just so you can.
Tell them I'll be there. Well, actually,
Lucky last.
Lucky last is 6.8. We have a report on levels of service for Q1. And I guess the focus has to be really on those that we're not quite on track for, and whether there's a risk that we're going to be there at the end, because this is what our community assesses us on effectively. So, Janice, have you got any comments?
Some of the ones that are red, through the chair, some of the ones that are red are annual. I'm just looking at page 79, the first one, it's results are generated at the end of the financial year. And that does come up in a few areas where they're showing as red because there is no data to collect at this point in time.
So maybe in the report, rather than putting 0%, maybe we change that to an annual assessment or something, so it's clear that that's not yet assessed or only assessed at year end.
Talk it through with Jonathan
See
before
what
I depart and see whether we can change the focus of the report.
Any other questions?
I guess for me, in the role that I have, I'm probably privy to more information or just the inner workings of our organisation. We have greater awareness of things. So things that I saw as read, I kind of already had an understanding of why they were potentially that way personally.
Yeah.
So I'm always concerned, but not overtly. So in this report, and know that we can take this up with our chief executive at any time.
And I think in a governance sense, we're in danger if we get too much and diving in too far. It's working out which ones are really key KPIs, if you, the super important ones.
The key for me to see improvement, continuous improvement at performance. It's a bit difficult to get
Yeah, one that I noted in there was the water supply, potential real water loss from the local authorities, and particularly the network. Given the weather over the last few days, you'd wonder why anyone would be worried about it, but if we get to that, it's going to cost us a lot of money.
Well, we end up chlorinating water that goes to water under some road somewhere.
It's a cost, it's not required.
It's definitely not a cost.
So just a highlight of that and see if that reduces. Would be handy. And the sewage has got a similar thing there. But we know the infrastructure's a bit sad.
Any other comments? In which case we have a recommendation on page 76. I have a mover and a seconder.
Yeah, so
Steve and John.
Yes.
Whoever. Everyone happy with that? Anyone against? No, carried.
Aye.
That's the last official item. I would just like to add in an extra wee item, and that is to recognise, Janice, this is your last meeting. You and I haven't sat close together for very many meetings. Just thank you for everything that you've given over the years, and all the best in your new role.
Thank you.
Down south.
Thank you.
As you head into the Wairarapa.
Yes, different set of problems, but very similar in lots of ways.
Oh yes, that's what I've learned with 5 councils under my belt at the moment. Just different shades of the same issues.
Yep.
I'm also aware that you've got a workshop at 2:30 and people probably want to have a brief break and they need to be set up. So given that it is 2:04, we better have a closing karakia. Good, thank you.
Thank you.
You insist.
There is a contingency of us who will be handing Janice over to a new council in Martinborough, South Wairarapa District Council. So I'll save my words for that occasion, of course, but just thank you very much, Janice. It's been very nice to over these past 4 years of mine, 18 years. May the seas be kind, listening to my gravestone and dance across thy pathway. Kia hone te marino, kia kapapangi me te moana, kia tere te karohirohi, mo e tō. Kia ora.